go live. So,
Oh, you are live, it says.
yes, we are on air. Perfect. Yeah, we'll just wait for people to kind of trickle in here. I'll put myself on mute in the meanwhile. Okay, perfect. Yeah, let's just give it a couple more minutes here.
Okay.
Awesome. Let's see. Get some people utilizing the chat option. Hi, Jesse from Alaska, and Vic from Houston. I'm in New York. Where are you, Angelique?
I'm in Louisiana, in the South.
Nice. Got people from all over.
Yeah, that's great to see. Indianapolis.
Got Idaho. Yeah, if you're just tuning in, we're just gonna give everybody a couple more minutes to join, and we'll get started here soon.
Well, lots of different states. Great.
How are you liking that it's getting darker earlier? Are you? I'm not a
Oh,
fan.
no, no. I need more sunlight.
Yeah, yeah. At least when you wake up early, it's sunny out now,
I
so
know
that's kind of nice.
it is, but it makes me tired when it's so dark.
It's true. It's true.
Makes me drink too much coffee.
Yeah, I found myself drinking coffee, my third cup around 4 o'clock, and I said, "Wait, whoa, this is too late. I'll be up till 3 a.m. at this point." Oh, awesome. Yeah, I guess we could get
We
started.
get started?
Yeah.
Yeah, that sounds great. Well, thank you everyone for joining us. This is our first webinar through Pro Landscaper. And yeah, we're very excited to partner up with these guys. Carla and Joe have very kindly taken their time tonight to talk us through budgeting. And we think it's a great time of year to do that. And hopefully everybody takes away some great pointers and tips. And yeah, we just have a bit of education session tonight. Like I said, we're partnering with these guys. They are landscape accountants, which makes it much more relevant.
Oh, it looks like Angela just dropped off there, but we'll give her maybe a minute or two to join, or else I'll continue it here with some technical difficulties. Oh, yeah, she's back. There we
Okay,
go.
sorry about that. So I did tell you it was our first webinar. I didn't touch a
Makes
thing,
it
I promise.
interesting. No worries.
Thank you to Carla. She's going to walk us through the course, and please put your questions in the chat box, but we will save those till the end. So if we don't answer your question right away, don't worry, we'll get to you. Thank you, and over to you, Carla.
Thank you, Angelique. Yeah, no, we're happy to be, collaborating on this webinar with Pro Landscaper, and yeah, so as you all may know, I'm Carla Iniguez Castro, CEO of Cycle CPA, where we specialize in green industry businesses, providing anything from bookkeeping all the way to CFO level services. And I'm excited to, be able to speak about the budgeting process, right? Especially as we're approaching year end here and planning for 2022. So I definitely think that there's a lot of key takeaways that you can use when you're planning your budget for your business for 2022. Please, I know some of these things, maybe I can get maybe too much in the weeds, or maybe you have some questions. So please leave your questions in the chat box and we'll answer them. All right. So we're going to go over the different components that should be part of your master budget. So your master budget is basically, this is your end goal, right? So let me zoom in here.
We don't see your screen.
Let's see.
Yeah.
You don't see my screen anymore?
I don't.
I'm going to turn it off and turn it back on, see if that works.
Oh, okay. Danielle. Oh, everybody else sees it. Okay, maybe it was just me.
Oh,
great. Thanks for confirming that. But I see it now. It just popped up. So
okay. Perfect.
Over to you again, Carla.
No worries. Yeah, no. So basically, your master budget is going to be composed of your company-wide budget, which is what we're looking at here, which is the end goal, right? You want to get to this company-wide budget. But basically, how you're going to come up with the figures for this budget is by producing your sales and production budget, your overhead budget, and your analysis. And then your cash flow forecast is another part of the company-wide budget that you should have in there, and also the capital budgeting aspect. And so what your master budget is consistent of is those components. And so with those components in mind, you'll have a lot of financial insight for when you're developing your 2022 budget, and when you're comparing once you get into 2022 and comparing your actual numbers to what was budgeted, you can see where maybe you were off in, and track your variance on that. So this is your end goal here. Again, this is your your company-wide budget. So I'm going to briefly go over what's included in this, and then I'm going to show you how to actually produce these numbers so that it ties back to this, right? So your company-wide budget shows your revenue numbers for January through December. And this is based on accrual basis. So accrual basis profit and loss. So here you are. Here we have design build revenue numbers for January through December, and maintenance revenue numbers from January to December. And then it consists of your direct cost as well. So those are your field labor salaries, field labor payroll taxes, supplies and materials, subcontractors, fuel, and equipment rentals. And right below that, it's your more of your overhead costs. So your advertising, your utilities, insurance, professional fees, telephone, overhead salaries, burden, training, merchant fees, depreciation. All of the overhead items are here. So, and then you come up with your total expenses, and then you have your net income for projected for each month. So basically, this is a projection of your profit and loss statement for next year. And so if we scroll over to the right in column O, we can see that this is an annual total for all of these rows, and then a percentage of revenue for each of these line items here. Okay, so let's get into the sales and production budget and how you're going to come up with those numbers. So starting off with the sales budget for design build revenue, we have here design build revenue from January all the way to December. Now, the way that we figured that out is that we pulled up a profit and loss for this company for accrual basis profit and loss for this company for 2020. And we saw that 2020, this company had 1.7 million about in sales for design build. And then in 2021, they had 1.9 million in sales for design build. And so when you look at the growth from 2020 in design build to 2021, the growth rate was 10%. And so when this company is projecting design build revenues for 2022, they want to grow at a faster rate than they grew from 2020 to 2021. They want to grow at 15% for the next year. So the way that we calculated the 15% growth is we pulled up a profit and loss accrual basis from January to December 2021, and you look at each month individually. And from January 2021, you multiply that number by 1.15, and then you're able to project what that would look like from a month-to-month basis. So you take your January 2021 number, you multiply that by 1.15, that's 15% growth. And so this is your new projected number for January, so 140,000, and you do that for each month here. And then this is the total for 2022. So for 2022, we're projecting then if you're going to increase that 15% each month, then for the year, you're going to be at 2.2 million. Compared to 2021, you were at 1.9, and that's 15% growth across the board. Okay, perfect. So that's how you're going to set up your sales budget for that division. And next, you're going to come up with the production side for that division. So the production is really more of, okay, how much labor hours am I going to have to spend on this division for each month? How much revenue do I have to generate, which we just came up with? But how much material, how much labor, how much subcontractors expense, equipment, gas and fuel, all of the cost of sales. What is my projected cost of sales for that division for that month? So first, you have to come up with your revenue per employee per hour for that division. And the way that you do that is you take all of your revenue for 2021 and all of your budgeted hours, and you're able to come up with your revenue per employee per hour. And that's on average, right? So for this company, by dissecting that data from 2021, we saw that on average, their revenue per employee per hour is $90. We have then budgeted direct labor hours. And so before I move on, the $90 per revenue per employee per hour, that's on average. And then that I put this across the board for January to December, right? That's what it's going to stay at. But then I have to figure, okay, what is my budgeted direct labor hours? How much field labor hours am I going to have in January to be able to produce $140,000 about in revenue, right? So the way that I do that is you take your $140,000 about and you divide that by your revenue per employee per hour. And so you're able to get your budgeted direct labor hours. So for this company, it's 1,562 for January. And you do that across the board for all the months. So that way you can see how much field labor hours you're projecting for that month. That way you can also see how many employees do I need for that month? What is my staffing need for that month, right? If you know how many hours you're projected to have for that amount of revenue, you can also see how many full-time, part-time, or subcontracted employees you will need for that month, right? You're able to forecast those staffing needs. And we'll get into that a little bit later. So then before I get into this line of projected projects to be completed, let's scroll down here. We have some historical data for this company. So the design build company, the design build division for this company in 2021, their average sales per project, so the average amount of sales that they had per project was $15,063. So by knowing that, and they completed 130 projects in 2021. So by knowing their average project size for this company, they're able to determine about how many projects need to be completed for all the months so that they can hit that revenue goal. So the way that I do that is I take the revenue, 140,000, right about, and I divide that by their average project size, which is 15,063, which they calculated based off of 2021 data. And so these are the amount of projects that need to be completed, an estimate, rough figure, because you can have a project that's larger than 15,000 or smaller, but this is about, the average size of the project. I think it's just nice to know, maybe on a, quantify that amount, how many projects that need to be completed within the month as well. And here I have revenue per employee per month. And the way that I get that is I have my revenue per employee per hour. So I have the $90 and I multiply that by 2,080 hours. 2,080 hours is the amount of working hours in a year. And then if you divide that by 12, you're able to know your revenue per employee per month. So here it's 15,600, and it's the same for January to December, right? And so you're able to project your staffing needs. So I have my revenue per employee per month, which is 15,600, and I divide that by my revenue, which is 140,000 about, and I get 9 employees per month that I would need, estimated figure about. And, as we can see here, that the amount of employees, go up during July, August, and September, because the amount of contracts also increase during those months, right? So you're able to project, okay, what should I do during those summer months? Should I leverage, subcontractors? Should I add more full-time employees? What am I going to do? I need to plan for that now. So next, we're going to get into the direct cost. And the direct cost, or cost of sales, I'm going to use those interchangeably. And what that consists of is your materials, your labor for field employees, and the burden for field employees, your subcontractors' expense, equipment and equipment rentals, and your fuel. So as you can see here, I'm able to project how much material I'm going to need for this month. And the way that we did it for this client is we pulled up a profit and loss for January through December on an accrual basis, and we made it as a percentage of revenue. And we looked on average, what is the percentage to revenue that this client spends on, or company spends on material, right? So for this company, it was 26% of revenue for material about. And so you're able to, because your revenue, you're able to just plug that percentage in and being able to project the amount of material cost that will need to be budgeted. Same thing with the labor. You take the percentage of labor to revenue. For this company, it was around 20% of revenue. Subcontractor, 2.5 for this company. Equipment, 10%, and fuel, 2% of revenue. And so a lot of these costs, right? All of these costs, I mean to say, cost of sales, materials, labor, subcontract, all of that increases as your sales increase, right? As you're increasing in revenue, you're going to spend more on materials. You're going to spend more in subcontractors. So if you look at 2021's numbers and you say, well, on average, I spent 26% on materials in my design build division, your revenue, so you can just work backwards, right? You know your percentage, and you can base that off of your revenue. So that's what we see here. And so you're able to come up with your total cost of sales. Again, what you came up with right here is all here. It's getting put back into your master budget, right? Moving on to maintenance department. So the sales budget for the maintenance department. Same thing as the design build. In 2020, the maintenance department had annual revenue of $252,000 about, compared to 2021, they ended at 277,000 about. So from 2020 to 2021, their growth rate was 10% if we calculate that. And so this company, again, wants to grow at a bigger rate than they did from 2020 to 2021. From 2021 to 2022, they want to grow at 15%. So we have 15% here. And again, what we did, pull up the profit and loss for 2021 from January to December on an accrual basis. And you look at your January 2021 number, you multiply that by 1.15, and you get your 16,262, right? So once you multiply those numbers by an extra, 15% growth rate across the board for each month, then the sum of that becomes 319,347 annual revenue of 2022 compared to 2021, which was only at 277. And so that's a 15% growth rate across the board. Again, starting off with the revenue per employee per hour, we took into account all the direct labor hours for the maintenance division in 2021 and all the revenues, and we came up with $60 on average revenue per employee per hour. And then you're able to derive your budgeted direct labor hours. Again, if I divide the revenue by the revenue per employee per hour, 271 direct labor hours, and then you do that for all the other months. So the reason why these are color coded down here, we see two different colors here. So that's because we want to dissect the maintenance revenue a little bit differently than the design build revenue, because the maintenance department has recurring revenue that's coming over from 2021 into 2022, contracts that are coming over that are being renewed. And so you want to separate that renewal revenue from the new maintenance revenue that you want to generate within the business, right? Because those wouldn't be counted as new sales. And so for this company, let's say for January, they had recurring maintenance revenue of 12,196. And again, we calculated the budgeted direct labor hours just for the renewals revenue. And then we have the new maintenance revenue. And the new maintenance revenue is just what you want your revenue to be for January, the 16,262, minus the recurring revenue for January. And then that gives you the residual, 4,065, that you would need in new revenue for the maintenance division for January. And this is the budgeted direct labor hours. Again, it's the revenue divided by the revenue per employee per hour. You get 68 here. And the contracts to be gained. So the new contracts that you need to gain within the maintenance department in January is 27 contracts. So as you can see here, it can get a little tricky with the maintenance department and the recurring revenue, because what happens is for this company, they had to gain a lot of new contracts in January, because for the rest of the months here, they gained a little less in contracts. And the reason is because for the maintenance department, each maintenance contract for the year is worth $1,800 for the year, for 12 months. That's how much revenue the recurring contracts bring in, is $1,800. So if I were to sell 27 contracts in January, I'm able to bill for January through December for those recurring revenue streams. But like in February, when I add in 4 contracts, I'm only able to bill for the next for February and to December, which is only 11 months. So I'm not gaining the full 1,800 in that year. I'm going to gain it next year, yes, because I'm able to bill for the full 12 months. So it's very important to note that and to be able to separate that. And there's no clear way to do that. There's no like mathematical equation that I can give you guys to like be able to figure that out. Well, not figure that out, but I mean, the way that you should be going about it is knowing that, okay, what is my yearly new maintenance goal? So here it's for the year, I need to make 79,836 from recurring maintenance contract, right? And so if I need to make that much, then how many contracts do I need to gain throughout the year so that I can make that much? Keeping in mind that if I bring someone on in June to December, then I only have, June to December to be able to bill. I'm not billing, I'm not retroactively billing. And so for this company, we just decided to, add on a lot of contracts in January. That way we have the next 12 months to bill, January to December. But you can spread out these amounts more evenly throughout the months. But my whole point here is to know how much your average maintenance contracts are worth, and to know that depending on how many contracts you're wanting, your salesperson to gain each month, that you're not going to bill for, the whole year unless you're coming in with, this, you're selling a lot in January, right? Because you're able to bill for the 12 months. So just keeping that in mind in the back of your head. So here we have material for the maintenance department. Again, we took 2021 numbers, profit and loss accrual basis, and made it as a percentage of revenue. For this client, it was, for this company, it was 6%. And for labor and burden, it was 36%, subcontractor 5%, equipment 10%, fuel 3%. And you do that for all of the other months. And then you come up with your total cost of sales here at the bottom. And then you get your annual total for maintenance, like you did for design build for your cost of sales. Awesome. Let's move on here to overhead. Just fix this here so you guys can see the totals. And also let me know, guys, if you need me to zoom in a little bit more on this Excel sheet, or if it looks good. Okay, perfect. So we have your indirect and overhead costs, which these costs are more like indirectly related to your sales. They're not directly related to your sales like the other costs where like your cost of sales and direct costs. So we have your overhead costs consist of fixed costs. So what that means are costs that really stay flat during the year and don't increase as your revenue increases. So think about things like rent. Like your rent is not going to increase as your revenue increases, things like your utilities or, your taxes or your uniforms or depreciation expense. Those things normally stay fixed unless you're making like a drastic change of, maybe you're adding on a new location or something like that. But normally those are more flat. They might vary a little bit, but not really throughout the year. So those are your fixed costs. And so we have a list of those here. And then you have your overhead costs that are also variable. So what that means is that they change or increase and decrease as revenue increases and decreases. So it follows the patterns of the revenue. So for example, as your revenue increases, so does advertising costs, I hope. As your revenue increases, so do your bad debts, unfortunately. Your dues and subscriptions, your small tools and equipment, your vehicles overhead expenses, and your merchant fees, right? Making more sales, more merchant fees have to go into that. So those are your variable costs. And so the way that you come up with your fixed costs is that you look at your historical data, 2021 data for rent, telephone, and so on. And unless you're making any changes or you're adding on more subscriptions to those should stay fairly constant, unless there's some price increases or anything like that. And so you can derive that information from that. And then your variable cost, the way that you get those. So since those change as your revenue changes, those, again, you would do the same thing as cost of sales. There would be a percentage of revenue. So for this client, advertising cost was a percentage of revenue. Bad debts was too. And so you take that and you make it a percent of your January revenue, February revenue, and so on, right? And once you have your total fixed cost and your total variable cost, you have to allocate those overhead expenses to your divisions. So it's very important to allocate them to your design build and your maintenance division, or whatever divisions you may have within your company. And so the way that you do that, let me just zoom out a little bit here. The way that you do that is, so we did this on an annual basis for this example, but you have to do this on a month to month. You have to allocate to these two divisions every single month. But for this basis, we did it on a monthly. So basically, the way that you want to think about it, so your biggest expense in your overhead should be your overhead salaries, right? And overhead salaries burden. And so that, depending on your company size, should be anywhere from 10 to 13% of revenue. So that's a big chunk of your overhead expenses. That will be the easiest to be able to allocate, and the biggest chunk to be able to get out of overhead and put it into these divisions. And the way that you go about that, for example, if you have a manager for your design build division, obviously his whole salary is going to be allocated to the design build division. But let's say you have a salesperson and they're working for the design build division and also for the maintenance division. You're going to allocate it based on the time that they spend selling or generating the revenue for design build or maintenance. Or let's say if you have an office employee, that office employee you can allocate by asking them, hey, what percentage of your time do you think you spend billing or doing an administrative task for design build versus maintenance? So here in design build, it makes up the revenue makes up most of the revenue for this company. So their answer should align with that. They should know, like, I usually spend 80% of my time in the design build or billing design build, invoices and so on. So that's the methodology that I want you guys to have, is what is the drivers that are driving these costs, and how can I allocate it out to the best of my ability? And so you take that same methodology and you do it with all of these expenses, right? You try to separate them as best as you can, but you start with the big expense, which is your overhead salaries. And then here, as you can see, we came up with that the percentage of revenue. So the overhead rate percentage for design build is 27%, and for maintenance it was 25%. So there is a 2% difference there, which means a lot in, you know, this company. 2% is a lot to be able to, you know, be off by. So it's very important to, again, be able to allocate those costs correctly to each division. So we have overhead per hour here for design build. And so that is your total overhead cost, which is the 618. And then you divide that by your direct labor hours for the design build, division, which is 25,000 that we calculated here already. And you're able to see what your overhead per hour is for this division. And you do the same thing for maintenance. So 2463, and over here 1503. Okay, great. And again, these overhead costs, again, you tie back into your budget, your master budget, right? Okay, great. So we have your cash flow forecast, which is, you know, one report that I enjoy the most, I would say, because it is dynamic. It changes with your business. And so it is the most relevant. Okay, so of course, everything is great when you have people knocking at your doors, wanting your services, you have jobs piled up for the next 6 months, or it becomes very easy to pay your expenses as they come due, pay your loans, pay your creditors. But there's always difficult situations in any business, and there's also unexpected events or downturns that create, you know, a lack of cash flow within the business. And many green industry businesses are seasonal, which makes it even more important to focus on cash flow. And one of the number one reasons why businesses go out of business is because the lack of cash flow. So being able to generate a cash flow forecast for your business and planning ahead of time, that's key, is such a great tool so that you're not caught in that bind, or so that you're able to avoid those binds and you're able to make informed business decisions rather than checking your bank account every hour or every day, or just going off of your gut feeling. That's when we get in a little bit of a problem, but we can make informed decisions, and this is how. So your forecast, you're projecting out the next 6 months or 12 months worth of your revenues on a cash basis, cash, not accrual. So we were talking about accrual before, now we're talking about cash. And you project out the next 6 to 12 months worth of expenses, which are your direct costs, overhead costs, plus your balance sheet items that should also be here. And so, you know, and this report gets updated every month. It never stays stale. Like your master budget's going to stay. Those numbers are there. You're just always going to compare that with your actual activity. These numbers need to get updated every month. I'll show you how. So here, I'm going to show you how I projected January sales number, which is 135,623 on a cash basis. So for here, we did January through June, only 6 months for this example, but I recommend doing at least, you know, you could do 6 months, but at least 12 months. You could even do 24 months if you would like, but to make it easy, we did 6 months. So what you want to do is you want to pull up your cash basis profit and loss for the past 2 years. So if I want to project 2022, I need to pull up profit and loss on a cash basis 2020 and 2021 revenue numbers. So for January, it was 100,000 about, and 2021, it was 115,000 about. So if I calculate that change from 2020 to 2021, it was 15%. And so you're using historical data to be able to project 2022 data. And so that's that part of it, right? And so the second part of the projection is, what is your current growth rate? That's also important too, because you want to grow. Maybe you're looking to grow at a faster rate. You're looking, you're expected to have more sales coming in, more, or maybe you added on an accounting staff that's going to collect payments for you faster or something like that. You want to know what your current growth rate is, what you're currently doing. So that's where the second part of this comes in. So you take your total sales, not month to month like we did in the first step. You take your total sales for the past trailing 6-month time frame. So again, if I'm forecasting January 2022 in this example, I'm going to take the past 6 months. So July 2021 to December 2021, because that's 6 months before January 2022. And so if I look at July 2021 to December 2021, I get 687,000 about for this company. And then I compare that to 2020, it was 618,000 about. So the growth rate is 10%, versus here was 15%. So actually this company is not on a month-to-month basis, from historical data, is growing faster than the current growth rate. So you may be saying, well, Carla, now this year I want to grow at 20%. That's great. But this is going to go off of your true number. So next month, when you go to update this, well, not next month, but at the end of January, when you know your January numbers and you're going to project February to July now, guess what? It's going to include your January numbers, January 22 growth rate from here. So it will be January through August. So you're going to have your growth rate in there already, because this is changing as your company changes. So that's when that's going to take that into account. So don't say, well, I feel like I'm growing at 20%. This will tell you, so it's great to have that transparency there. So next, your third thing that you want to do to come up with your projection is that we have the calculation from step 1, historical data. We have our current growth rate, and we want to marry the two, right? Because they're both relevant information, but we want to marry those two. And the way that we do that is I'm going to take you through the calculation. So we first take the 115,000 from 2021 January cash basis sales, and then we multiply that by 1.15, this number here. And then you multiply that by 50%, because you're weighing it at only 50%. You're going to add that to, you're going to take the 2021 cash basis sales, which is 115,000 again, and then you're going to multiply that at this growth rate, 1.1, and you're going to weigh that at 50% too. So you got 50% historical, 50% current, marry that, and you come up with your projected sales for January 2022, which is 135,623. And so again, this is cash basis, so it's different. It's actually what is going to hit your bank account for that month. And the key differences between a budget and a cash flow forecast is that this is based on your cash basis profit and loss. It includes your balance sheet items. It changes every month based on your current growth rate or decline. It's more dynamic. It moves with you. So when COVID hit, these came in handy for our clients, right? It's great for scenario planning because it shows you what's actually feasible. Do you have that money so you can buy that truck, so you can add on those employees, so you can put that down payment? It tells you that. Are you going to need to take out a loan? Are you going to do a loan plus the down payment? Which month is that better to do that in? Do I have more money in the bank in June, or do I have more money in the bank in April, right? So it's going to give you ideas like that. So let me go through and show you. So you're going to start off with the opening balance from the bank statement in January. So what that is when you look at your bank statement for all your business accounts, you're going to add that up for December 2021. What is the closing statement balance? Everybody has seen that before, right? So you're going to add all of those up, and you're going to be your opening balance in January, right? So you put that number here. Then you have your forecasted sales, right? We got from these formulas for January to June. And again, this is based on cash in, cash out. So if you're going to plan on receiving any loans, that's money coming into your account. For this company, there's no loans that are coming in. But for example, some of you receive PPP money. Any of those items that are going to come into your account, you would put that on this line. Owner's investment, do you constantly have to put money from your own pocket into your business, right? Or do you do that, maybe you add in $1,000 each month on average, or what is that? So that's going to go on here as well. All cash in items. It doesn't just have to be revenue. And then that gives you your total outflows, your total inflows, I mean. And so we move on to the outflows, which these are a percentage of your sales. So we're going to do this the same way we did with our master budget, but instead pull up a profit and loss as a percentage of revenue on a cash basis. So you're able to project. So we have revenue. You just do these as a percentage of revenue as well. And then you have your overhead cost as a percentage of revenue, or your fixed costs here as well. So you have your direct, your overhead cost projection for January on a cash basis. And so the balance sheet items, this is something that makes this different than your master budget. So there are things on your balance sheet that are not in your profit and loss statement. So for example, if you're making payments on your F-350, truck for $650 each month, that's not on your profit and loss. But that still comes out of your bank account every single month. You know it, you feel it, it's there. So those items also need to be here. Something else that you might not think of is your equity section of your balance sheet. So your owner's draw. Do you withdraw some money every month from the account for personal expenses or to pay yourself, cash in? Those are also things coming out of items coming out of your bank account, cash items. There are some things that are on your profit and loss that shouldn't be on here as well. So for example, depreciation expense, that's not an actual cash transaction. So that's not included in here either. So just be, or AR bad debt. That's not an actual cash expense. So that's not in here either, right? So then you have your, balance sheet, your total balance sheet outflows, which is the total of these items here. And then you get your total outflows, what is going to come out of your bank account each month. And so that's just a sum of your total direct costs, overhead costs, plus your balance sheet items. That's your total cash outflow. And your net cash flow, what that is your inflows, your total inflows, minus your total outflows. And so for this company, in March, you can see that they're negative. That means that their total outflows coming out of the account is higher than their total inflows, than their total sales. So they're going to be expending more than they are generating in sales. But their closing balance is still positive because they have enough of a cash cushion to be able to support that during those months. So the closing balance is a projection of what your closing balance is going to be in your bank accounts. So the formula for that is your opening balance, what you opened with, minus your net cash flow, or plus your net cash flow. And so that gives you your projection of your closing balance. And like I mentioned before, cash flow forecasts are great for scenario planning. So let's say that you're looking to increase 5%, a price increase of 5%. You're looking to implement an increase in pricing. And so you can see what that would do to your cash flow if you have this. So here we have new cash inflow from the price increase of 5%. So what we did here is you just took your revenue and then you multiply that by 1.05. So you increase that by 5%. And so you have your new cash. So here, if you were to increase your pricing by 5%, you would be having, cash inflows or sales of 142,000 versus if you didn't, it would be at 135,000. So it increased. Your net cash flow now is higher, 22,000 versus 15, and you have more money in the bank, which is nice. So you have 48,000 versus 41,000. So it increased your cash flow of 7,000. About another scenario for this company is that they want to purchase a new truck for the owner. So the owner is tired of sharing his truck with the employees. They want to purchase a new truck here. So we said, okay, that's all great, but let's see if we can do it. So they would like to put $15,000 down in March, and then their payments after that, their monthly payments on their trucks is $350. Now we also have to account. So with the new truck comes more insurance costs. So we see that the insurance is also going to increase by $142. Gas is also going to increase, right? Because you're adding on a new truck, $162. But it's also going to generate more revenue because now the owner has more time to go out, create more estimates, be more efficient on the jobs, is able to supervise more jobs. And so we, calculated the amount of new revenue that they're able to generate from this new truck. So we have our new cash outflow, which is all the expenses. So in particular, I want to look at March in particular. So total new cash inflow is 5,985, which is the new sales that are going to be generated. But the new net cash flow is negative 12,000 as opposed to negative 3611. So that just means, again, that they're expending more than they're selling during that period. So the new closing balance for March is projected to be 41,000 versus 50. So they're going to be left with less in the bank. But can they do it? Yes, because their bank account is still positive, right? And so you're looking at, by adding on this truck, they're going to generate more positive cash flows in the closing balance as opposed to if they didn't, because of the new sales they're able to generate. Okay, great. So now you have created all of these great budgets and your cash flow forecasts, and now it's time to analyze some things here. So let me just, okay, great. So for the first analysis you want to look at is your break-even analysis. And that's when, and you want to look at this graph. So your break-even point is when total sales equal your total cost. And that's at this point right here. So total sales equal your total cost. And what does that mean? That means zero left over for you, zero profit. So you're just breaking even at this point. And for this company, I calculated the break-even point on an annual basis, but you can take the same calculation and do it for every month. So at what point do I need to, what sales figure do I need to hit to break even for every single month, which would be nice. And then you can tell that to your maintenance managers or your design build managers. This is how much we need to hit at least so I can cover my costs. But obviously their goal is going to be above that because we want to generate profit, right? But it's just great for your managers to know. A couple more things that I want to mention before I get into the calculations is that, as you can see here, your fixed costs stay constant, like I mentioned before. These items don't change with revenue. So whether you have revenue or you don't, you still need to pay these items. But your variable cost increases as your sales increase too. And so here, this is the sales amount that you need in order to generate net income. And so we're going to figure all of that out here. So your fixed cost, your break-even point is your fixed cost, divide that by your contribution margin. So let me explain first the contribution margin. So your contribution margin is your revenue per hour per employee minus your total variable cost per hour. So that's 90, and that's your variable cost per hour. And your contribution margin is your revenue per hour minus your variable cost per hour. And this is your contribution margin for this design build company is $31.65 per hour. They have this amount to be able to cover their fixed costs and also make a profit. So your variable cost per hour, I'll get into how you're able to calculate that number. So your variable cost here for this design build is 1.4 million. And so you go to your production budget. We calculated your variable cost here for cost of sales, which is 1.3 here. But then you also have variable costs in your overhead. Remember when we went over these here, it's 114,000. So you add those two numbers. Those numbers change when your sales change. They increase, they decrease as your sales decrease. So you add those two numbers up and you get 1.4 variable cost, total variable cost. And then you get your direct labor hours for that division. So again, we calculated that here, 25,000 about. And you can get 1.4 million, divide that by your total budgeted labor hours, and you get your variable cost per hour. So what that means is, on average, for every hour that you work, that includes labor, materials, subcontractors, equipment, you spend $58 on those items about. So, and then you subtract that by your revenue per hour per employee, that's 90, and you're left over with $31.65 to be able to cover these fixed costs that are not going anywhere and to be able to generate profit. So, so then you're able to calculate your contribution margin, which is your sales revenue per hour. That's the $90 minus the variable cost per hour. That's the $58.35. And then you divide that by your sales price per hour, the $90 again. Your contribution margin is 0.35 or 35% for this company. So then once you figure that out, you're able to calculate your break-even sales dollars. So fixed cost divided by the contribution margin. The contribution margin we figured out. The fixed cost for this is 504. That comes from your sales and from your overhead budget, which was here, your fixed cost. The items that do not change as your revenue changes, these items don't change. That's 504. So you take the 504,000, divide that by 0.35, and you get your break-even sales dollars. For this company, it's 1.4 million. So in order for them to break even for the year, they have to generate revenue of at least 1.4 million. Again, it's really beneficial if you did this on a month-to-month basis, right? And so if you have the sales dollars, you're just it's easy to calculate how much break-even direct labor hours are needed. So that's your break-even sales dollars, 1.4, and you divide that by your $90 per employee per hour. And you get 15,926. Perfect. And okay, so then you have your targeted profit. So remember, here you're breaking even. You're making no profit. You're just going to cover your fixed costs. You're not losing money. You're not making money. But down here with this calculation, you're going to plug in what is your desired profit that you want to make. What do I have to generate in sales so that I'm able to make my desired profit, right? So here, for the design build side, my targeted profit for the year is $290,241 for the year. But again, you can do this on a monthly basis for your targeted profit, and you're able to relay that to your managers, right? So this is great. So for me, I want to make $290,000 for the year for the design build for profit. And so I'm able to calculate how much sales do I need to be able to generate that profit. So the calculation for that is my target profit, which is 290,000. I add my fixed cost to that, which is 504, and I divide that by my contribution margin, which we figured out before, which is 0.35. And so the amount of sales that I need to generate to be able to make this profit here that I'm looking for is $2.2 million for this department. That's the revenue number that I need to hit for this year so I can make that profit. Now, how many labor hours do I need to be able to hit that sales revenue? Again, sales divided by revenue per employee, right? And then that gives you 25,095. Perfect. And again, you do that for your other department. Again, I strongly recommend that you do this on a month-to-month basis because your break-even point, that's what you need to make so that you're not losing money or you're not making money, you're breaking even for that month. And then your targeted profit per month is how much you want to make in net income and how much sales that you're needing to generate for that month. So that way you can make that net income. And then the way that you can relay that to your managers is, look, this is how much budgeted direct labor hours we need to make. This is the amount of sales we need to produce for this month. Okay, great. So the final slide is the capital budgeting. Okay, so capital budgeting, what it's concerned with the acquisition of long-term fixed assets. So what that is you're looking to make an investment within your business you're looking to purchase a skid steer, or you're looking to purchase a high reach or a new truck, or you're looking to maybe implement a new location or a new service line. But these are long-term investments, and you're looking to invest into these, but maybe you are unsure which one to which capital investments to put your resources or your capital towards, right? You have these 2 projects in mind or 5 projects in mind, and you want to pick the one that is going to create the best return on your investment, right? That's the whole goal here. And so there is a way to be able to evaluate those investments so that you can make the best choice for your company. So the most popular, there are different evaluation techniques to evaluate those 2 investments. And the most popular one is the net present value approach. There are other ones that you can look up, but this is just the most popular and the most accurate one, in my opinion, because this approach incorporates the expected cash inflows from those investments. So the revenues that you will be generating for those investments, the savings of the project, and also the expected cash outflow. So what is the initial investment that you need to make into those into that project? But it also takes into account the time value of money. The time value of money is the concept that a sum of money is worth more now than it is at a future date. So for example, if I get $500 tomorrow, it's worth more to me, than it will be if I get those $500 in 2 years from now, right? So it takes into account those two methodologies, and that's why it's the most popular approach. So here, this company is considering these two capital investments. And so they're choosing between, should I invest in a front-end loader or should I invest in a greenhouse in 2022? So each of these projects requires $275,000 of investment. It's a straight, some of the assumptions are that it's a straight line depreciation will be used and there's no residual value. And the business has selected 10% cost of capital for purpose of this net present value analysis. The cost of capital is a company's calculation of the minimum return that would be necessary in order to justify the undertaking of this capital project. So 10% is the amount of return that I want to, that I would expect to make, from these projects. And so you can Google this, you can take a picture of this chart here, but basically what this chart is called the present value of $1 at compounded interest. And here, this company chose 10%. That's how much they want to make from the project at least. And so you can see the years here and the multiple here. So for example, for year one, for 10%, it would be 0.909. So we'll see this here and so on for the rest of the years. So basically we have front end loader here. They're looking to make $155,000 in the first year of net cash flow. So what that means is that the front end loader is going to generate $155,000 of net cash flow. So that's revenues minus expenses. What's left over for me is $155,000 from this front end loader. You multiply that by the present value multiple, which is 0.909, and you get the present value of this money. So 140,895. So in a year from now, I'm going to see 155,000, right? But what's it worth to me today as we are speaking? So that's the 140. It's worth less, right? Like I mentioned before. So we do the same thing for the greenhouse. So for the greenhouse, you can see that in the first year, it generates $248,000 worth of free cash flow for me. The present value is $225,000. When you add up all of these numbers, though, the total is the same. It generates $775,000 for a front end loader, and for the greenhouse, $775,000. We're going to see another thing here as we go on. So what you want to do is that you want to take the present value of the net cash flows, which is the 587 for the front end loader and the 620 from the greenhouse, and your initial investment, which is the $275,000. So you want to take that amount, the 587, and you want to subtract that from the investment you're going to have to make, right? You're subtracting that amount to see what you're going to be left over with. What's your return on this investment, or the net present value? So for the front end loader, it was $312,000, and then for the greenhouse, $345,000. And so here you're able to see that, when you're making your capital project ranking decisions, that if the net present value is 0 or positive, then the project is economically feasible. You should usually go for it. But if it's a negative number, it should be rejected. You shouldn't even look to invest in that. But here we see that these two are positive numbers, and we see that the greenhouse is generating more net cash flow, $345,000. So a key takeaway here is that the reason why the greenhouse ended up generating a higher net cash flow than the front end loader is because the front end loader brought in the same amount of cash flows each year. It didn't change year 1 through 5, right? But the greenhouse, though, it generated more money, right? More net cash flow, revenue minus expenses in the first year, 248,000. And like I said, the closer the period is, the more that it's worth to you now rather than 5 years from now. And so if you can take away anything from this example here, you may not do this for your company, or you may not look into this, but know that if one of your investments are going to generate more money for you earlier on, you're going to get a return on your money, a higher return earlier on. That may be, something that you want to consider, rather than if you're going to get a return in 5 years from now, right? Because again, with the time value of money concept, you want to be able to have more money more earlier on, right? So that's what this is, the key takeaway here is. Okay, awesome. So just wrapping up here. But I hope you guys all enjoyed this, and I'm gonna open this up to a couple of questions here. Let's see, just looking for. Let's see. Okay, great.
I think you've answered everything that's been asked.
Yeah, I have. I'm like, wait, I'm just looking here, but yeah, I enjoyed my time here with all of you guys, and you, Angelique.
Well, I thought your walkthrough was great, and you made it very relevant to real life design and build and maintenance companies. And yeah, I see a lot of people asking about the Excel sheet as well, because it was really clear, how you walked us through that. So and I also like the scenario planning and how you linked it to staff planning as well, because we all are seeing staff and workforce being a big issue lately. So thank you for making it so relevant to us.
No problem, Angelique. I'm glad that I made it clear, and that I'm glad that you all had some key takeaways. But if anybody has any questions, needs help with building out their budget and or cash flow forecast, this is exactly what we do. We prepare all of these reports and different items here for our clients. So definitely feel free to email me or call me, and we can talk more about it. But thank you, Angelique. Thank you for Pro Landscaper, for joining us within this webinar. It was a great one here.
Yes, thank you so much. I think there's a lot of good comments there. And just so everybody knows, you will get a copy to the recording of the webinar as well. So please share it if you think somebody can use it.
Thank you. Have a great night.
Bye.
Bye.